Vishwanath Mahendra, ED and CFO at Niva Bupa, joining us on the show. Mr. Mahendra, hi, good morning, and thank you so much for your time. All round a beat coming in for you in the quarter gone by, and you've continued to outgrow the industry, and you've also gained further retail market share. What's driving this outperformance, and can you talk to us about how sustainable is the kind of growth that you've seen in quarter one?
Yeah, good morning to you and all your viewers, and thanks for inviting me to the show. So, just to put in perspective, as we know, you would recall last financial year, mid of last financial year, there was a GST exemption on account of retail health. That has really helped the industry, and industry, if we just see the quarter one in retail health itself, grew by 32%. In case of Niva Bupa, our growth is, of course, higher by 40 from 32% to 47%. So our Q1 growth is 47% against 32% of industry, and that is driven by few factors. One, just to capitalize on this opportunity, we added, headcounts in all the channels. We added 1,000 headcounts, especially on sales side, in all channels, be it banker, agency, third party, direct. So that's one. And we also adding similar 1,000 headcounts in this financial year, again, to invest in all the channels. So that's one big, lever. Second, we launched another, blockbuster product last financial year. Incidentally, that also came around same time when GST was exempted in retail health, Reassure 3.0. That has been received very well, equally by distributors as well as customers. So, and of course, as always, keep giving our customers best service in terms of claims settlement. Our claim settlement rate for Q1 is close to 96%. So these are the few things which have really helped.
Sounds good. Mr. Mahendra, let's talk about segments now. Retail health remains your biggest growth engine while you've consciously slowed growth in the group business. Is this now a long-term strategic shift towards profitability over scale?
Yeah, that's a good point you have raised. So last Q1, our retail grew by 47% and group was flat. The swing was, let's say, in last financial year Q1, we had 70% retail. This year Q1, it is 75% retail. So our philosophy around group health is we write business only if it makes commercial sense. If it is not value accretive, we don't write that kind of business. Our focus has been on SMEs. SMEs, one segment in group health where we feel that we can write that business sustainably. Now, going forward, it really depends on market, and we have seen in last decade or two, there are underwriting cycles. Sometimes, rates are soft, especially when it comes to group health. Sometimes rates harden. So last 2-3 quarters, we have seen rates were soft, and that's why we stayed away from that kind of business. But tomorrow, suppose rates harden, we are not averse to writing that kind of business. So very much, it can move back to, let's say, 70-30 kind of mix.
Okay, understood. And Mr. Mahendra, combined ratio, that has improved to 100.2%, driven by a lower loss ratio. How much more room are you seeing for further improvement in the combined ratio, and what could be the key levers from here?
Yeah. So if we see combined ratio in last financial year was, 103.2% for first quarter, which has improved to 100.2, like you mentioned. And that's something our guidance is, let's say by FY29, we want to improve this combined insurance service ratio to, let's say, between 98 to 99%. And that we are very much on that trajectory. The beauty of India is that the trajectory will be very smooth unless there is some outlier quarter where infection is very high. It will lead to very smooth sale to between 98 to 99% by FY27. What that means is, in terms of return on equity, post-tax return on equity, in last 4 quarters, rolling quarters, it is around 12%. The same will result in, let's say, between mid to high teens by FY29, which is 15 to 17%.
Understood. Your VNB and margins have also improved despite higher acquisition costs. As you continue investing in distribution, as we understand, how are you looking to balance growth with profitability?
The profitability, of course, is primary focus. So we don't write any business which is inherently not profit making. But at the same time, we also understand that we need to make investment in different channels ahead of time. So as long as the business we are writing is sustainable, we are okay to invest, even if that means the slightly higher combined ratio. But inherently, that business should be profitable. That's our philosophy, and that's the reason. Like we were discussing group health, we stayed away from that because that business was inherently not profit making for that quarter or last 2 quarters, and it was difficult to turn around that business later on, especially on large corporates.
Okay, understood. And Mr. Mahendra, you've spoken about maintaining an 8 to 10% growth premium over the industry. What's giving you the confidence to sustain that in an increasingly competitive health insurance market?
So one is the investment in all distribution channels. So that's something which is going to continue. If you see last 5 6 years, our market share used to be 4%, 5%. That has moved to 11% now. Even in last 1 year, the market share has improved by 110 basis point. So that continuous investment in distribution channels, in technology, in AI, all those levers, and of course, most importantly, delivering customer value and customer services. Those are the things which may sound very basic, but these are the most important things.
Mr. Mahendra, good morning. Ashesha this side. Let's also talk about claim trends, and you did talk about it a tad bit. But now that we are entering seasonal illness period, what's the trend looking like, and how are you preparing for a potential uptick in claims over the next couple of quarters?
Yeah, morning, Shisha. So as far as July is concerned, we have not seen any outlier in terms of claims. This been around what was historical trend in last 4 months. How we are preparing is, see, one is if there is infection higher. So most important is to give deliver service to our customer. So that's the most important thing. Claims ratio comes second. So in case there is infection which is higher than usual, so we are very much prepared in terms of our capacity and capability to serve our customers. That's most important. And as I told you, that there may be some quarters where claims are on a higher side. So those things are not really a worry to us.
Okay, understood. And the outlook looks really nice. You've also guided for a mid to high teen ROE by FY29. So we'll be watching out for that as well. Mr. Mahendra, thank you so much for your time. And thanks for chalking out your growth plan going ahead. Thank you so much.
Thank you. My pleasure. Thank you.
Thank you. Okay, viewers, on that note, time to step into a very short break on this edition of Midcap Masala. On the other side of the break, we'll keep the earnings conversations going and interact with the management of ESAF Small Finance Bank. Stay tuned and we'll be right back.